in Shane Obata for his take on the markets. Welcome to the show. It's great to have you here.
Thanks for having me.
I read your notes on the current markets, and you are not as bothered by the narrow breadth that everybody has been bothered about, it seems, during the first half of the year. And that's those, whatever you want to call them, the Magnificent Seven, those mega cap tech stocks are being responsible for really all the gains on the S&P 500. Why are you not unconcerned?
It's, you know what, it's hard not to be concerned in the market. I will say that every day you're kind of fighting to stay positive. So I wouldn't say I'm fully 100% bullish. There's things that I'm worried about. I'll talk about interest rates and inflation in a little bit, but if you look at the history of the stock market, the outsized gains have come from a small subset of companies. It's not totally out of normal, for example. So that's kind of the beauty of investing, is you could have an investment that goes down 100%, but if you're a long-only investor, you're only buying, you could have something that goes up 10,000% over time. So hopefully you can find some of those in your lifetime and it makes a big difference, but that's the longer-term study. And then maybe a shorter-term study, there's some good research from Goldman Sachs that showed that the top 10 stocks make up about 32% of the S&P 500's gains in the median year since 1995, I think. So leadership, of course, we want, our firm wants breadth to expand. We want to see that in the second half, but we're not necessarily scared by the narrow leadership.
Does it make sense that the tech stocks have rallied so much while central banks, most notably the Fed, have continued to remove liquidity from the marketplace by raising interest rates? That was the huge concern in the latter portion of 2022 when they came down in a big way.
It's also a reversal of last year, right? Saw the most outsized pain. I think really more than ever now, the market is so highly dependent on interest rates. All markets are really dependent on interest rates, right? And so we went through this period of worrying about rates and inflation, and we're now getting past that. There's still work to do, but we're getting past that. So if we think about tech as a longer duration asset, meaning that a lot of the value of an equity of a tech company could be in the outer years, basically. So that's why those stocks performed the worst when inflation was the biggest problem, and now they're rebounding. So that's a long-winded way of getting back around, but part of it is a rebound, and then part of it is kind of a return to the idea that they can lead in growth also. So it's interesting, there was a period in time where if we looked at, I can't remember the exact moment, but historically you had the FANG stocks, or whatever you want to call them, generating much better than the market in terms of sales growth and earnings growth for a long period of time. And that's why they commanded a premium. That's why they were so sought after. There was a period of time coming out of COVID where that was no longer the case. But now we're coming back to the same thing, where expectations have ratcheted up. We could see earnings, the sales growth, for example, 2-3 times higher than the market over the next few years. So I do think there's fundamental underpinnings here. Sure, some of the year-to-date gains have been pretty amazing, but it's not all fluff.
Our first question comes by way of the email inbox. Our viewer is Steve, and his subject matter is portfolio liquidity. He writes as follows: thinking that a recession is in progress, that appears to be his view, what percentage of a personal portfolio should be in liquid assets for potential future purchases?
I'll set the stage by saying it's always going to depend on your own personal financial situation, right? So that's why we have people who can help us, financial advisors, planners, et cetera. So you have to take that holistic approach coming into it. But generally speaking, I think just talking about your allocation to stocks, one of the best strategies for investors, non-professional investors over time, has just been dollar cost averaging, which is to continually invest in the market over time, try to set aside a certain amount of your disposable income and continue investing. Because one thing that I learned in just doing research on the market is that volatility works both ways. If you are in cash and you miss a large downside move, it's highly likely that you're going to miss a large upside move to the other side.
Right.
And so oftentimes it's very difficult, if not impossible, to time the market. So I think it's better to just try to find companies you like, deploy into them over time. So managing your cash in big swings is very difficult.
Do you like the model often recommended by personal finance experts of quote unquote, paying yourself first? So every paycheck, a certain amount of money goes to your brokerage account and perhaps gets deployed?
Yeah, I think anything that assuming you can afford it, right? But anything that takes the decision-making, I guess, off of the plate. If
Right.
it's just set in stone, I think that's great, because then you don't have to make that active decision every month, so.
Okay, thanks for that question. Let's go to another email. Enyo is our email writer. The subject here is Oracle. I'm interested in your opinion on Oracle as a under-the-radar AI, artificial intelligence play.
What a stock this has been. And we haven't been involved in the name for a while, so we've missed out. It's done phenomenally well. When you think about the big cloud players, you think about Amazon, then you think about Microsoft, you think about Google. Now, I think there's probably different ways of measuring this, but I saw estimates of Oracle's market share in cloud somewhere around 2%, 3%. It's small, but it's growing very, very quickly. So it's a good company, I think. For me, I've had the opportunity cost problem with Oracle. I'd rather probably own Microsoft. I'd rather probably own Amazon and Google. So perhaps that's why I missed out on this one. But I don't think you're going to get hurt owning Oracle for the next little while.
Okay.
You're doing well.
Thanks for that question. Let's go to the phones for the first time in the show. Nate is calling from St. Catharines. Hi, Nate.
Hey, guys. Just wanted to get Shane's thoughts on the big six banks. Thanks.
Yes. So on the Canadian banks, I think we're known for having a tighter, more concentrated and more resilient banking sector. So I think that's still the case. If we think about, broadly speaking, where the most value is in the market, as in where asset prices most depressed in equities, it would be banks and energy stocks. That is where the extreme value is. That's where the cyclical bent is as well. So I would say you're safe owning the Canadian banks for a long time. And the one thing that is embedded in the thought of buying them now, though, is just how the economy progresses, because they are cyclical in nature. So if the economy gets a little bit worse in Canada, that's going to be a problem. But that's not necessarily our base case, and just kind of setting the stage there.
Russ is our email writer. Brookfield Corporation, ticker symbol BN on the TSX, is the subject. Where do you see the price for Brookfield going?
Yeah, so we own Brookfield, and we also own Brookfield Asset Management. So the difference is really just how the structure is. So Brookfield Asset Management now is meant to be a vehicle that gives you access basically entirely to the fee stream that Brookfield earns on running different mandates. Whereas Brookfield, the BN ticker, that's a little bit more balance sheet heavy. They're going to have more assets on their balance sheet. They have stakes in BAM. They have a stake in BEP, a stake in BIP. So coming back to Brookfield, we think it's tremendously undervalued right now. If you look at a sum of the parts valuation, if you take out their stake in BAM and you take out their stakes in their other listed equities, you're basically getting a negative value for their real estate. And their real estate is over $30 billion in IFRS value. So we know the challenges in office are likely to persist for a little while longer, or for some time longer. But nevertheless, they have good properties, and we think that it's a little absurd that's not getting any value right now. So you basically get the rest of their business for free.
Okay, thanks to Russ for that question. Let's go to Galen now. Galen is also writing to our email inbox. The subject is Alphabet, a well-known stock, ticker symbol GOOGL. There's a couple different versions. He cites that one. He says he's comparing the opportunity between buying Alphabet versus ASML Holdings at current prices.
Right, so these are both great companies for different reasons. I would say I like both of them as long-term holds, but very different companies, right? ASML is in semiconductor manufacturing equipment. They make very, very cutting-edge machines that cost hundreds of millions of dollars per unit. It's actually very amazing. So we do have some concerns in the near term here about the risk from China and the tit for tat that's going on right now. And because of the environment we're still in, where people are trying to be conservative in terms of margins and whatnot, I think that there is a risk that people push back their orders a little bit, but nevertheless, on a longer term time horizon, continue to like ASML a lot. And then Google is still one of my favorite companies. I think that I've thought that they have been the leader in AI, that was kind of called into question with the emergence of OpenAI and the Microsoft partnership, et cetera. But Google has some of the best, if not the best, AI capabilities in the world. And so I think that will continue to power through on this stock. It's not very expensive. ASML, on the other hand, is quite expensive, but it's more of a monopoly structure. Google is not very expensive. So I like both names, but you have to decide what end market you're kind of targeting, because they're very different businesses. Okay,
let's go back to the phones. Lou is in Oro-Medonte, Ontario. Hi, Lou.
Hi there, how you doing? I was wondering if you could compare Canadian Tire, CTCA, to maybe Alimentation Couche-Tard.
Yeah, so Canadian Tire was a name that we were looking at late last year, and we sort of missed the boat on that. I was a little bit shy of getting into it because of the main reason was really concerns about the macro. Like, I think Canadian Tire has a great business. It serves as a one-stop shop. I think that the loyalty program is highly attractive, and so I feel like we missed it a little bit, but I do think this is a good company. It's not expensive, so it's one that you can own for a while. Couche-Tard, I think, has done pretty well, but between the two, I would probably take Canadian Tire for the next year or so.
Okay, thanks for that question, Lou. Al is an email writer. His subject is Constellation Software, ticker symbol CSU on the TSX. What are your thoughts on Constellation Software? Is it a buy, sell, or a hold?
Yes, so we already own Constellation Software, so for us it's a hold, but I think people that don't have exposure to it could start building a position at current levels. I don't see the problem with that. They have grown tremendously, and the question was really, will their business model scale? And I just think it's rigorous discipline that has made this such a success story. So we're talking about conservative valuations for the companies they're acquiring, high internal hurdle rates, the return on investment that they need to get, and that's powered through, and it's led to consistent growth, good EBITDA margins, and so they're continuing to deploy, and that's all they really need to do, is to remain disciplined and to keep deploying.
What does the company's debt profile look like? Acquisitions is what it does.
Yeah. I think the balance sheet is pretty good. I can't remember off the top of my head what the debt stack looks like, but I'll come back to you on that.
Welcome back. It's time now for Past Picks. Shane visited with us on July the 22nd of 2022, about a year ago exactly, and his top pick on that day was NVIDIA, ticker symbol NVDA on the Nasdaq. And I think most of us know what's happened to NVIDIA over the past several months. There you see the numbers, up 147%. Shane, I think the question a lot of viewers might be asking is, do you buy now at 428 and change US?
Buying now is always a tough question. For us, we actually have been adding recently. So we've held this name for a while. We used to own more at the end of 2021, but anyways, it's a great story. We knew the AI angle, and then it's been swept into this new wave, right? So the bottom line is this: they're dominant in the GPU space. You need GPUs for AI. If you're starting an AI company, you go to NVIDIA. If you're building in-house AI capabilities, you go to NVIDIA. So they're not the only game in town. We think that eventually the excess demand is going to go to other players. Maybe AMD can start making inroads in the back half of the year. But NVIDIA is a great company. That recent quarter was one of the best I've ever seen. And the interesting part was earnings growth estimates got ratcheted up so much after that print that even following the stock's rise, which I think was top 5 single-day gains in market cap for one stock ever, the valuation went down. It's still very high, but if we're talking about slightly under a 50 times forward multiple, that seems very high, of course, at first glance, but the long-term earnings EPS growth rate on Bloomberg now is over 40%. So with that lens, it's more reasonable.
Okay.
Great company.
Number 2, Motorola Solutions, ticker symbol MSI on the New York Stock Exchange. There's what we see in that story, less under the spotlight perhaps than NVIDIA, but you can see a 32% and 33% return respectively, depending on whether or not you include dividends.
Another great company, another name that we fully intend to continue holding. So they made their the historical business, the cash cow is radio communications, which seems like a pretty boring business, but there's an element of mission critical here when we think about police and firemen and security, et cetera. So that's kind of the cash cow of the business that's continuing to grow, actually defying the skeptics at a, call it mid-single digit rate. But the more interesting sides, or what we were interested in, was kind of the hardware, if that's hardware to software transition. And the most interesting part to me is the video security cameras. So we know that public safety is top of mind as we get more and more people in the big cities. Unfortunately, sometimes bad things happen. And there is a privacy element here. You can have different opinions on that. My personal opinion is I think people will choose safety over privacy. If you're filming me walking down the street, I'm all the way on one end here, so I don't really care, but I think public safety is a really interesting thing, and that part of their business, the video cameras, which is still small. I think it's only about over $1 billion now, but a small part of the business growing 20%.
Okay, we'll go to past pick number 3. We go to the luxury segment, LVMH. That's the Louis Vuitton company. Trades in Paris. We see some pretty good numbers there as well. There are the respective prices a year ago and now in euros, and you can see the gains of 34% and 36% respectively.
Still another core holding for us that we have no intentions of selling. I guess one question is about Mr. Arnault's succession and how that eventually happens. I think he'd like to give pieces to his kids and whatnot, but he is one of the best operators that I've ever encountered in the market. And so it will be difficult to replace his legacy, but this is a great company. It's basically a holding company of various fashion houses. They have, in my opinion, the best portfolio of luxury assets. So they work across different areas. Their most profitable one is fashion and leather goods. You'll know the Louis Vuitton brand, and Dior looks like it's gaining market share as well. Wine and spirits also highly profitable. They were able to execute right through COVID, and unlike other areas that are more subject to the normal laws of economics, they've just had insane pricing power. You raise prices, people want your stuff more. It's very counterintuitive, but that's the luxury business for you, right? So all of that has resulted in operating margins that are at record highs. So it's been great execution and great brand strength. So great portfolio of assets. I think as long as they continue doing what they're doing, it's a good company. Okay,
those are Shane Obata's past picks. Shane, of course, is portfolio manager at Middlefield Capital. He'll continue taking your questions on global large cap stocks right after this. Let's go to the phones. Frank is in Hamilton. Frank, first of all, thanks for calling. Second of all, what's your question to Shane Obata?
Hi, good afternoon. Yes, I'm interested in Mr. Obata's views on Amazon, and in particular his views on Amazon's ability to benefit from this movement, this AI movement. Thank you. I'll hang up and listen to your answer.
Thanks for the question. So Amazon is still a great company here, and I'll get to the AI question in a bit because it's kind of been left out of the whole picture here. And I don't think that's totally true, but let's just take a step back and look at the full company. So it's one that's historically been expensive. We're talking about very low net interest margins, like 1%, 2%, 3%, right? As the company goes forward, we'll have hopefully better efficiency on the e-commerce side. The cloud business and the advertising business are both growing faster and will become bigger parts of the whole business. All of that together should improve the company's margin profile over time. And so I think that will help Amazon eventually get back to the highs. And so coming back to AI just quickly, it makes sense that people that want to use AI capabilities that can't build them in-house, which is a lot of people. OpenAI said building one of their facilities would cost $100 million, for example. I mean, that's no small sum, maybe for the big companies, but anyways, here's the point. If you're already partnered with Amazon for cloud services and you want to run some AI models, you're probably going to ask them if they have some, and they already do. So I think the market is going to get wind of that story over the back half of the year, and Amazon will be included in this. And I think it makes sense for them to benefit from all of this interest in artificial intelligence.
Okay, thanks for that question. Let's go to Supreet. He's calling from Manitoba. Hi, Supreet. Are you there, Supreet? Okay, my notes indicate that Supreet was interested in asking about Rivian, one of the EV makers. I believe Rivian specializes in vans and trucks, correct?
Yeah, the trucks. So I've seen good reviews on their products. I would say this is obviously an earlier kind of show me story. So we continue to prefer Tesla, and if we're thinking about the auto space, probably wouldn't include Rivian, but it's on the radar. The movement to electric vehicles is going to continue. People want it, companies want it, countries want it. So it's going to continue. This is a name that we'll have on our radar, but for now we would prefer Tesla for this kind of exposure. Okay, thanks, Supreet, for that question. Leonard is in Brampton. Hi, Leonard.
Hi, good afternoon. I've just got a quick question for Shane. I have a stock called Kinder Morgan, and in my RSP account, but what I noticed is last year they took all the dividend back, and my broker say it's because they do that to lower your cost. But because it's in my RSP account, I wonder, should I sell it? Because the reason why I bought it is for the dividend. So if I have to return the dividend in order to lower the cost, then I don't think it's a good choice to put in the RSP. I'll hang up and listen to your answer.
Okay, I'm not going to go down that path too much.
Yeah, I have to confess, I don't know what the caller is referring to when he says they took the dividend back. I've checked the company's dividend history going right up until April of this year, and on April of this year, it declared a dividend of 28.25 cents per share, and the dividends over the past couple of years have increased. So I'm a bit of a loss there. What's your thought on this pipeline operator?
Yeah, I would just say I don't follow this name that closely, but we do like energy infrastructure as an area that's a highly attractive area and a key part of the energy transition. So I would say our preference would be to stick with a name like Enbridge versus Kinder, but I think you're in the right area. Energy infrastructure is a good area. And yeah, I'm not going to go into the dividend side of this or the tax side.
Keith is in Brampton. Hi, Keith, and thanks for calling.
Hi, guys. Thanks for taking my call. Shane, I'd like your thoughts on PayPal. I'll hang up and listen to your response. Thank you.
So we don't have exposure currently. It's a name that we've followed, and we're not following as closely recently, but it was pretty amazing to see this name and many others go from being a growth stock to technically a value stock. There was a time when you never thought you'd see a PE under 20 for PayPal. So there's there's leverage to the continued growth of e-commerce here. That's the key driver for PayPal. I don't think that trend is going anywhere, but we have pretty limited exposure to fintech, and if we do, the boring answer, but probably the right one, is to buy the networks. I think if we're going to buy PayPal or Visa, we'll probably buy Visa.
Right.
And continue to monitor PayPal. So
everybody uses PayPal, ultimately goes to one of their credit cards, ultimately, or the overwhelming majority. Let's go to Costa now. Costa's in Montreal. Hi, Costa.
Hello, gentlemen. Thank you for taking my call. I would appreciate your thoughts on Shopify. Are we still bullish on this name? She's had a great run this year. Where do you see the stock heading towards the rest of the year? Thank you very much. Have a great day.
Yeah, Shopify is again a name that we were following more closely previously. I think if you want, I think they'll have a decent time over the next while. It's been on a great run, as you can see there. I'm always thinking about opportunity cost. So if we're going into this area of the market, I would probably take Amazon, to be honest, over Shopify. But I do think Shopify is a good Canadian company. It may take some time to get everything in order, but I think the long term is bright for Shopify, but for now I would stick with Amazon.
Okay. Yeah. Andrew's in Waterloo. Hi, Andrew, and thank you for your call.
Good afternoon, gentlemen, and thank you for taking my call. My question is on analog devices. I'm just wondering if it's a buy at this level, and will AI come in or factor into their products? I'll listen to your answer. Thank you very much.
Yeah, thanks for the question. Analog Devices is a great company, so I'm glad you asked about it. It's not really what would come to mind in terms of an AI beneficiary, but this is what I would consider as like an industrial focused semiconductor company. So it's not entirely focused on autos as you would have with some other companies, but that's a blossoming part of the business for them. They make tens of thousands. Their closest comparable is Texas Instruments, but we have a preference for ADI, and we've added to it this year. So they're making tens of thousands of SKUs. Some of them are kind of out-of-the-box, plug-and-play things, but the beauty of analog semiconductors is that they're very complex. Instead of zeros and ones, you're talking about interacting with the physical world, which is more complicated. So turning like weight into something that's measurable, into math.
Right.
And because of that complexity, it takes a long time to design products. When products are designed, they sit in those bigger systems for the lifetime of the system. And so basically there's a lot of staying power here is what I'm saying. They've got a good technological advantage, very, very well-diversified business. We're especially excited about the auto side, so really good company.
What have investors been buying into as they've bid this stock up substantially over the past year or so?
The auto side has been the strongest part. As you know, there's been stories of the semiconductor market going to 1 trillion and above. A large part of that is coming from autos, right? Because if we think about modern day cars, you're gonna have motion sensors all over the place. You're gonna have semiconductors in your entertainment systems, your cameras, your optical your cameras. So the gist of it is higher dollar content, higher semiconductor dollar content going into these cars over time. And then one particular area that's really interesting with Analog Devices is they build these battery management systems that they're partnered with the vast majority of the major automakers. And so what they're doing is they're trying to make it so that you're charging most effectively to not reduce the wear on the battery and kind of extend its life. So they're all about charging efficiency for electric vehicles. So that's a really interesting part of their business.
Okay,
yeah. Let's
go back to the email inbox. Michael is our writer. He wants to know about Palo Alto Networks, ticker symbol PANW, on the New York Stock Exchange. Would you buy Palo Alto at these levels?
Yes, so Palo Alto, I would say, is our top pick in cybersecurity. Recently added to the S&P 500, which I think is goes to show that this is a real company with real GAAP profits. So Palo Alto, we think, will be a key beneficiary of vendor consolidation. And so in cybersecurity, you're going to have network security, endpoint security, cloud security. The list goes on. You might have, same with software in general, you're going to have too many products, too many vendors as people look to reduce the complexity of their business and use less vendors. We think Palo Alto Networks is going to emerge as a platform, one of the leading platforms. We also like Fortinet. So this is a good company. It's expensive on a PE basis, but we think this is something that can grow free cash flow in the 20% plus camp for the foreseeable future, especially as their next-gen products come more into play here. And just to give some perspective, their firewall business is still growing at about 6%. That was the core of the old business. And there is some legacy tech there, but it's still growing. Their new next generation stuff is supposed to grow at maybe 5 times that rate over the next few years. So,
okay, let's squeeze in one more question before we take a break and get to top picks. Arthur is our email writer this time. Intel is the subject. Do you have any thoughts on Intel? Do you see further recovery and growth, or is it too late? That company has struggled.
Yes. I'm starting to want to like Intel, but it's hard to do. So the story that what we were focused on had been focused on for a few years was the idea of AMD really operating at a high level, having better technology, executing really well in terms of the cadence of the upgrades, and taking share from Intel and servers. So Intel not only has to kind of right their own ship in terms of getting back on track in terms of their technology and their execution, but now you have the foundry business, which I think will be successful over the long term, but now you're competing with Taiwan Semiconductor, which is a very good company. So long story short, this is a complicated story. We do think the stock is probably undervalued. The PE ratio is kind of hiding the true value here because earnings have been blown up, and so that's extended the PE ratio. But we do think this one will succeed over time, hopefully, but we're going to continue watching it for a little while longer before we step in here. There's a lot of other good names.
Welcome back. Let's go to top picks from Shane Obata. Top pick number 1, Broadcom, ticker symbol AVGO. Shane?
Yeah, Broadcom has been a great name for us, and we're continuing to hold this as a top pick or one of our core positions especially in our tech mandates. So this is a pretty well-diversified company. It's mostly a semiconductor company, but there's also a very slow-growing infrastructure software business. And what we're really excited about lately, we're talking about where else to look besides NVIDIA when it comes to AI. So Broadcom is going to be, we think, one of the first beneficiaries after NVIDIA. And the funny thing is, unlike Jensen, who's the CEO of NVIDIA, and he's always fully embracing whatever trend is coming his way, right? So he's saying, generative AI, this is the next iPhone moment, for example. So Broadcom's management is more conservative. They're kind of taking it as it goes, and their estimates are that AI-related revenues will grow to 25% next year from 10% in 2022. That's based on actual orders and not just them hypothesizing about what can happen. And so there's two important areas that they're benefiting from. So the first one is these custom chips that they're building with companies such as Google and Meta. So I think these companies looked around, they said, okay, we don't really love how much power NVIDIA has, so why don't we try to build some things internally? So we've seen it with Apple's M1 chip, we've seen it with Google's TPUs, Amazon and Meta all doing their own chips internally. Well, some of them are partnering with Broadcom to do this, and they're built to do Google's workloads, for example. So this is multi-billion-dollar partnerships. So the Google partnership was already in the billions, and then the Meta partnership is expected to get into the billions. So these are going to be significant parts of the business very soon. And the other part is on the networking side. So to explain this at a high level, basically, when we want to do more AI computing, we need more computing power, we need more GPUs, we need more CPUs, we need more of that power, but we also need to make sure that our networking capabilities are going to match. So we need to make sure our bandwidth is high, how much information can be translated or moved around, and also the speed of that. And another thing that's going to become increasingly important is how energy efficient it is. And so all of those things, we think Broadcom is doing well with its networking chips. So exposed to AI in a couple different ways, but that's not the whole story. We like the whole business, but we do find that exciting.
Okay. Blackstone is number 2, top pick on this day, ticker symbol BX on the New York Stock Exchange.
Right. So I pitched last time I think I was on, I pitched Brookfield Asset. It's the same idea. We think that the alternative asset space is dominated by a small number of companies that just have tremendous scale. There's only a few businesses that can do the deals at the higher end. We've seen Brookfield on a deal-making spree this year, for example. They just have good scale and best practices they can share across businesses. So Blackstone started in private equity, but has become much more diversified. Most of the business is actually related to real estate now. So they've been caught up in the same concerns that we've seen in the market about commercial real estate and whatnot. They're much less exposed than Brookfield is. They have said that office represents just 2% of their US real estate portfolio now. So we think likely this is going to be a difficult year, maybe 6 months to 18 months for Blackstone, given the real estate environment. But the overarching macro is that we think we're getting close to the peak in rates. That should help the real estate market. It should help deal making. And Blackstone has over $190 billion of dry powder. So when some others are under pressure, they have the ability to make good acquisitions. So it's a story that we think will play out over time. We expect that they can do easily 15% growth in fee-related earnings over time. So it's a great company. I would consider them the best alts manager in the world.
Okay, let's go to Nintendo. It's a Japanese traded stock in Tokyo. It is, of course, a gaming company, and there you see its ticker number on the Tokyo Stock Exchange. Shane.
Yeah. Try something different here with a Japanese name, but I think the Japanese market has been very strong this year. It's becoming more shareholder friendly, and when you look outside of the States, you often find more value, right? So I think people will continue to be interested in Japan. Nintendo doesn't fall into the deep value camp. It's forward P's like 20 times. This is a little bit of a nuanced story here because they're heavily dependent on console sales. So the Switch was tremendously successful, selling well over 100 million consoles. But when you reach year 3, 4, 5, 6 of your console cycle, your sales naturally decline, and even if you're still selling games. So this is a company that could have to deal with negative sales growth for the next couple years. But what we're excited about is with the launch of the Super Mario movie, which was a blockbuster, I think it was 1.3 billion in worldwide gross, which is pretty awesome. The whole idea of IP synergies across divisions, which we've heard many times from different companies, this is a company that can really do that. And so the basic gist of it is you take IP from your video game franchise, Zelda, Pokemon, Super Mario, and then you make a movie or use it in some other format. And then when people watch the movie, that drives console sales again, and that drives video game sales again. And so we think that kind of fortuitous wheel can continue to help Nintendo and help the company probably surprise to the upside, even though the expectations are quite low.